Hey guys, Freaky Finance here, and happy holidays. Today we're going to continue on with the toys around Christmas. So last time we did Funko, and this time we're going to do Build-A-Bear. This is a fun one that's kind of been on an upswing lately because of its performance, and we'll go through the numbers in a sec. I do own this one, I just started a position, and basically again the theme is to try to get in, and when it gets cheaper, again, it is relatively cheap, but again that assumes that the current performance continues, which may or may not happen. But yeah, anyway, I do own it, and let's get into it. So Build-A-Bear is kind of neat in that it's not just buying a bear online. They actually have an experience where you go into the store and actually build a bear with your kid or significant other or what have you. So it's kind of unique in that regard. And I think one of the reasons why, like, we have seen a pullback in goods, and I think one of the reasons why we haven't seen as big a pullback in Build-A-Bear is because it's linked to kind of that experience aspect, or at least that's what I'd argue. So we haven't seen a huge kind of like, like COVID and then the too good to be true year, then the chase year, then the decline year. We haven't actually seen that with Build-A-Bear. We've just seen kind of what I would call, it looks like a turnaround story. But again, I'm not sure how much legs that has, if it's continue or if it's just a fluke and it's about to collapse on me. So it's a convoluted video, but the business itself, like if I just look at where it is now versus where it was, the business does look superior. Again, here's ones you can just buy online, so they do have a direct online channel store to buy stuff. And different themes, obviously, different age groups, different people. They have lots for a holiday. Right now it's around Christmas time. Today that I'm filming this is the 21st of December. They have 3 segments they break out, but the most critical is by far the direct-to-consumer line, and those are the stores that you go into to actually build the bears, as well as their 2 e-commerce sites are also included in that. They do have a commercial business, and that's mainly wholesale, and then they do have an international franchising model, which is also, I'd say, very small, so relatively immaterial to our investment thesis. Really, what's going to drive the success of this business at this point will be the DTC. Here's kind of like the description of the business, where they kind of explain that which guests can make their own stuffed animals by participating in the stuffing, fluffing, dressing, accessorizing, and naming of their own teddy bears. And again, I think this aspect is one of the reasons why we haven't seen the decline that we've seen in physical goods, because of the experience that's tied into. I just wanted to point that out again there, because it is rather unique. They do own, in terms of property, they do own 1 distribution center, but basically all their retail stores are leased. And in terms of their employees, really you got 25% working full-time and 75% part-time. The part-time is probably important because some of these will be more seasonal, right? So you're probably thinking like your Valentine's Day, your Christmas, right? Will be the drivers where you need to make sure you have the people there. But you can see that kind of split out. In terms of the expenses, this is important just before we go to the numbers, so try to figure out what goes where. So they do have, in COGS, they'll have royalties in there, as well as the warehouse distribution, the packaging, the stuffing itself, right, the actual COGS, shortages, shipping, handling, stuff like that. And then in the SGA, they actually have the payroll. They do have store occupancy cost in the COGS. So that means basically when wages are going up too quickly, you should see pressure on the SGA line relative to its revenue. And then if COGS is going up or down, that could be quite a number of things. There's a lot going on in COGS. Just where they're located, they're corporately managed locations, because they do have a franchise model, which is relatively small, but for purposes of where they actually have the locations, largely still in North America play. You're talking 90% North America, 10% Europe, and they closed their only shop in China in 2022. And in terms of franchising, it's kind of interesting when you think about it. Again, not really material to our investment thesis because the segment's so small, but you can see they actually have quite a lot in South Africa for international franchises and Australia, which is kind of interesting. Yeah, worth looking at it anyway. Kind of why specifically those 2 places, especially when indexed for population. Anyway, in terms of who their consumer is, skews female, very young relatively for most of it, but they do have 40% teens and adults. So, and that trend has been slowly going up over time. I think they're actually trying to target that. We'll go through their strategy and why the business actually looks superior than what it used to be. They also do target higher earning households. So remember City Trends, I remember we did that video and it was more like I'm pretty sure I did the video. And anyway, they try and target the very lower end consumer, very strapped for cash. Whereas I'd argue Build-A-Bear targets more to wealthier individuals. So it's worth bringing up as well. Maybe that's the reason why they haven't seen the same amount of pullback. Similar to Funko that we did and Jack Specific, they also license out IP. So you can see that here again, a lot of Disney, Pokemon, Gremlins, Marvel, Jurassic World, Trolls, Star Wars, Warner Bros. The usual suspects. And that allows you to build a bear with a big IP. They did just have the most record profitable year in 2022, and they did guide for improved on 2023. So they are comping the comp. So that is interesting. It's also a reason why the share price isn't coming down as much as it used to, because the business looks like it's actually permanently improved. But the thing is, I'm not sure if that's necessarily true or not. It just looks like it, and it probably is, but it's hard for me to tell exactly what's driving it and if that can just continue. So let's jump into the numbers. Usually I don't have so many green things, but it's all pretty green. It's hard. The only thing I could talk about that's bad is probably the valuation, but even then it screens cheap. Like you're talking 7 times earnings, 4 times EBITDA, right? So very cheap. Not the cheapest things on our list, but very cheap for a company that's pretty much just been up and to the right for the last 3 years since COVID. Now it always wasn't like that. Build-A-Bear has actually been relatively stuck for a decade. It's really the last 3 years that it's come out of it. And what I mean by that, it's been very inconsistent. There's very limited top line growth, and then like some years it would be profitable and other years it would be very unprofitable. Now it's always kept a pretty clean balance sheet, and it's always kept a pretty disciplined inventory. So what's interesting here, and if I had to go to the crux of why the business has improved so much, it's just the sales per square foot have just accelerated meaningfully over the last 2 years, and this trend has continued in 2023 so far. So anyway, let's just start from the top. You can see revenue is nearing all-time highs. It's actually hit all-time highs in 2023. And though it was stuck, like it was having a hell of a time to try to get over 400 million for the longest time. And again, this is a smaller company. You can see the other segments, commercial, the wholesaler, and the franchising model, very small relative to their overall business. You're talking 21 million into a $450 million number. So relatively small. So we're not going to spend much time at all on them. You can see that the largest expense after COGS is SG&A. And importantly, when you go down here, you can see the SG&A is actually scaling pretty good. It used to be about 43% of sales, 44% of sales, 46. Take the average, it's 45. And in the last couple of years, it's been 40 and 39. Now it's recently come back up because we have seen wage inflation still. So that's one of the reasons why the earnings per share growth rate has slowed in 2023. And it's one of the reasons why we're starting to see the price come back down a bit. At least that's what I argue. What else is there? The balance sheet is very pristine. This is a very clean, like if you look at the financials, it's very clean. It's very easy to read. So it makes it easy for me. There's not a lot of noise going on. Anyway, what else is there? The cash, they always seem to have a net cash on the balance sheet, which is nice. Free cash flow, generally it's been slightly free cash flow positive. That's recently accelerated. And while 33 million might not sound like too much for you, you have to remember the company is only worth $350 million. And if I take out the cash, it's $314 million. So very, very cheap to what its cash flow is at a time 10 times. So not like dumb cheap, but not expensive. But the cool thing with this company is that they're finally starting to buy back shares and pay dividends with the cash flow. So we are starting to see the share count come down. It's lower than this now. The cool thing here is that GM has just gone up. Like, so you've seen gross margin average 43% going into COVID, and then after COVID, it's averaged 52%, almost 53%. So you're getting like a 10% bump more in margins. So something's happened here. Either they've taken enough price, which is possible, or there's something going on in the supply chain where they're just being better or being able to charge more or something. Something's happening here, and it's hard for me to know exactly what it is, but it's obvious that this is a step change up, and this continued into 2023 as well. We have seen SGA, well, it's not as good as this year was. Last year, 2022, we have seen wage and pressure come back up. It's still very good. Like, we're netting about 10% more profitability than we used to. Like, say if we're at 13 or 10% now, we used to only be at 4, right? And that was in a good year. So we basically almost, I'd say we have at least doubled and almost tripled the profitability profile of the company. in relatively short order. And the thing is, it's hard for me to know, is this repeatable? Is this trend aggressive? Will these margins stay, right? Um, but it looks really good. Because when you look at the stock chart, it doesn't look that exciting, right? The thing used to trade at like $5, $8, and now it's at $23. Like, well, I missed it, and it's kind of like, oh, it's actually screening cheaper than it ever has before, right? Which is kind of interesting. Inventory has been relatively well managed, so you can see that here, like it's been really going up with sales, which is a good thing to see because that would be hard to do during COVID when your demand just plummets. You have to respond really quickly, and then when it shoots back up, you have to respond very quickly. And so far, it looks like they've nailed it, which is pretty impressive. We are seeing the EPS keep going up lately. Part of that is the profitability profile improving, and part of that's also the buybacks that they're doing with their cash flow because they already have a pristine balance sheet. And so whether it trades at 6 or 7 times earnings is still relatively cheap. But again, we don't know exactly what this business can look like 10 years from now, right? Or is it going to be more inconsistent like it was in the past? So far, it looks like it's a trend and a step change up. But it's definitely an interesting business model, and I still, like after this video, I'm going to try to like dig deeper and more into the drivers to try to make sure like, are these things sustainable or not, and why, right? In terms of the latest quarter, partially more of the same. I'd say it's getting a little bit harder. We're seeing some slowdown, some macro weakness. That's one of the reasons why the share price is pulling back. And I always want to do a video on this one, and I was like, it's a decent time to do it for Christmas. I mean, ideally, I'd like to get it cheaper, but it's starting to screen cheaper again. Earnings per share is up here over here, partially just because they bought back so much of themselves because the valuation is so cheap and the cash flow is so decent relative towards it. They can buy back a decent amount of themselves each year at the current share price and the current fundamentals. So whereas even though the business looks like it's starting to stall year over year, the EPS is still going up because of the buyback. So they're making it through financial engineering there. And then you can see the $37 billion that they paid back to shareholders in 9 months, which isn't small for a company that's only worth $300 million. Right? So pretty impressive, I'd say, overall. And it is nice that it doesn't have any real debt. Here's them, basically management saying they've turned the business around. You can see how slow the growth rate's been though. Like you only up 80 million in a decade. That's like growing 8 million a year. So very, very small growth rate. But you can see the business has just improved dramatically. Part of that, maybe it's digital driven. They're saying that their margin just in general, they're just operating at a higher level, getting 25% contribution margin for 100% of the stores, and before then they're barely over 10 for 80%. So material step change on a profitability per store basis. Again, I think that's linked to the square foot growth that we've seen. I'm not sure whether that's taking price or just operating more effectively. And the reason why I'm leaning towards taking price is this last one, where they say the average appreciation dollars per transaction. Instead of someone paying $35 in 2012, they're now paying $50 in 2022. So I think there have just been something's happened here where they either feel like they can charge more. In any event, they are charging more, and so that's what I think is improving the margins more. Is that they're probably taking more price than what their cost structure has increased over since COVID started. This could also be a good sign because we haven't seen volumes come down. That because it's because it's more services driven, experience driven, maybe it's less price sensitive. So, and maybe that's why they feel comfortable taking this, and that's maybe why we're not seeing a pushback on volumes or transactions in general. So yeah, I thought that was worth bringing up. So their strategy, according to them, and why they're been able to get better numbers is 3 things. They call it 3 pillars. They say that they've diversified the experience and business model, they've transformed and improved on the digital capabilities, and they expanded both the categories and the number of consumers that they're targeting. So the first one, experience locations. You can see that they're trying to get out of traditional malls. They're still largely in traditional malls, but you can see here, open 20 new locations, Six Flags, Pro Football Hall of Fame, right? You see here they have their core ones, Cedar Fair and Knott's Berry, right? And then you have things like third-party retail models in Busch Gardens, Carnival Cruise Line, right? They're trying to start up there, and then you have franchises in foreign countries. But you can kind of see where they're trying to go and make it even more experience located. So whether you want to be in a tourist location or an amusement park, right, or a cruise ship, they want to be there, meet you. I thought this was an interesting strategy on the e-commerce. So basically, they're saying their primary target inside malls and experience locations are families with children. But online, they're trying to target the tween, the teen, and the adult, the collector or gift giver. So I thought that was interesting. They claim that this is one of the reasons why they've had the success that they've had. And you can see that they're getting 70% teen or adult here, versus here they're getting 67% kids. So it looks like the strategy's working, especially on their fixed asset base. But again, a part of that could just be having more sales online probably improves the margin profile of the overall business. Here again, 135% growth over the last 3 years. Part of that's also the shift from, we've seen just e-commerce just outgrow. I thought that was worth bringing up. Here, I just wanted to point out just how stuck it has been and how inconsistent it is. So like if I were to look at the business right now, it looks like a buy, and I did buy a little bit of it. But the reason why I'm more hesitant is because in the past it hasn't been consistent. Like some years are good, like here you get $1 in earnings, and all of a sudden it doubles to $1.60 in earnings, and the next year it's down to barely breaking even, right? And here you have 50 cents in earnings, now you're down $1, right? It's very consistent, and until the last couple of years. Really, this will be the third year of consistency where it looks like it's improved. So I think what happened is that the company felt comfortable during COVID to take prices up during the reopening, and it's just rode that ever since. That's what I think. And because it's experience driven, it hasn't had that pushback on price. And to be fair, maybe it was always undercharging what it could have charged. That's what it would also appear to be doing. But anyway, that's just my conjecture there. In terms of insiders, they're just constantly selling, so it's not a good sign there. To be fair, this thing has been traded very poorly for a long period of time, so maybe they're just trying to register now that it's no longer in the $5 to $8 range. In terms of the share price, you can see the reason why it's not like I'm head over heels about it, but I am excited because the business is good. Just that the valuation isn't like dumb, right? It's not like 2 times EBITDA, it's at 4 times, right? Like there's a lot of companies that are still like at 3 times EBITDA or 2 times. Right, that doesn't mean I don't think, like I don't know if it will ever get to 10 or 8, but somebody panicked and sold us to $1, right, during the COVID panic, even though the balance sheet was fine. So this company has a history of weak hands, and so it'd be very nice if I could get this type of deal, right? Longer term, you can see that the market hasn't been kind to them. Part of that has been a lack of performance, honestly. Like they've been barely growing, and they've been unable to meaningfully and consistently increase earnings per share. That is until COVID happened. So does that just mean that's just because of COVID and I'm still having that mean reversion past it and I'm going to be suckered into it? Or does that mean that they actually did something and that is a step change that's permanent? In terms of ownership, there's a few funds that have a decent ranking to it. I haven't gone into any of them. This is actually a good sign, though, in terms of I would have liked to have see a CEO own like 5% of the company or 10% of the company or something, right? But there's none of that here. So again, in terms of insider alignment, you can see that they're just selling. So here is them. One of the reasons why I want to do the video now is because it's starting to pull back, because they're starting to say that they're starting to see some softness in sales. We saw this in other companies. They said the last part of October was weak, and it started to still be weak in November. Here's the 3 key initiatives. We kind of talked about them, right? So the first one is evolving and expanding the experience location footprint. That's you're going to more cruise lines and more experience-driven amusement parks, stuff like that. And then your acceleration to digital transformation. Again, you're targeting the say like the more tweens and adults online, and I'm targeting the more kids and the families for the experiences in the actual storefront. So that's what I like, and I think that's going to just generate more value over time for these guys, especially over their fixed cost base. I did think this was interesting is that they said that they did show some improvement in December. That makes this hard to time, right? So I wish they would have said things are still bad, right? And then I'd probably get a cheaper price once they report the bad news. Even though it should be guided, there's only like 3 analysts following us, and I think there's the question, if you ever listen to these calls of these smaller companies, no one ever really listens to them. There's no one really on them. So it's kind of nice. That's how I know this one. It's kind of, it could be just a diamond in a rough, right? Just because of 7 times earnings, it could easily go to 14 if it actually starts growing. EPS, call it 8% a year, right? 7% a year, right? This thing should re-rate higher if it can do that, but who knows if it can. And if it doesn't, they should just be buying back more and more shares for their cash flow until it eventually does. Gross margin. So this is what's kind of happening right now on the latest quarter. You can see you're seeing gross margin improvement. Part of that's lower freight, as well as leverage on the distribution costs. But we're also seeing SGA go up because of higher wages. So it's kind of netting the two out, and that's why the year over year is starting to seize up. And so maybe the market's front running more declines. But I think personally that wages are finally starting to flatline, and they should be able to push price again. They already showed that they could. And that's the management team that's supposedly turned the business around, and it looks like they have. I just want to show that real quick. And then in terms of what they've done, they have actually, I checked this out just to make sure, they have actually totaled over $80 million in stock repurchases and dividends over the last 7 quarters. So that's kind of interesting when a business is only worth $300 million. They've already returned $80 million to shareholders, so very friendly lately anyway. And that is a step change as well. So not only is the business more profitable, but they're also giving more back to shareholders. So anyway, I thought you'd find this one interesting. It's kind of a unique company, kind of the experiences and the goods crossbreed. It's finally starting to get cheaper. It's not dumb cheap yet, but it's something that I think anyone should put on their watch list. I'll be back near the end of the year or the beginning of the next year. Take care.